In my view, the market has massively overreacted to actually what happened, because the market, generally speaking, has been trying to extrapolate from this particular debacle to basically about what actually is going on generally, whereas I think this is a very much of an isolated case.
On today's episode of the WTFinance podcast, I have the pleasure of speaking with David Wu, who's a former top-ranked Wall Street strategist, IMF economist, and founder of Unbound, which is both a YouTube channel which publishes great videos every week talking about current market events and what's happening in the world, as well as a global forum devoted to the promotion of the fact-based debates and about markets, politics, and economics. So, David, thanks for joining the podcast today.
Thanks for having me.
No problem. So yeah, I think there's really only one thing to talk about, and we'll talk about this before, is the collapse of SVB and what that really means, I guess, not just for the US, but for the global economy. So maybe can you give us your thoughts on that, maybe how this has gotten to the stage at the moment and what this means for the future going forward?
Okay, great. I think, first of all, I think it's very important for your viewers to understand what exactly has gone down, because in my view, the market has massively overreacted to actually what happened, because the market, generally speaking, has been trying to extrapolate from this particular debacle to basically about what actually is going on generally, whereas I think this is a very much of an isolated case. To understand this, just think about this. SVB, right, the Silicon Valley Bank, basically was the fastest growing bank from, I think, 2000 to 2020 to 2022. And there's only one reason for it. It was because during the pandemic, I have to tell you, because interest rate went to zero, tech was flying. And it was very easy for any new startups to basically get new funding. As a result, the amount of money that was pouring into VCs that was then in turn pouring into basically these startups was basically through the moon. And to the extent that the Silicon Valley Bank is in the business of providing banking business services to basically startups, obviously they did very well in terms of attracting lots of deposits. Now, what did they do with that deposit money, right? Because this is not like Lehman Brothers that decided to use its balance sheet to buy, subprime securities, or that this is not other banks, let's say during the savings and loan crisis in the 80s, that basically channeled the money into real estate or other risky loans. SVB basically essentially invested its money, its clients' money, into what it thought was the safest assets in the world, which are, guess what? US government bonds, right? So again, you have to remember, SVB did very well because their clients did very well in a very low interest rate environment. And they turned around and invested that money into bonds, which basically implicitly assumed that low interest rate environments are going to be here to stay. Okay. Now, of course, what's happened over the past year is that as interest rates go up, VCs are now basically much more slow in terms of deploying their capital if they're seeing any inflows at all. As a result, basically, startups are withdrawing their money to the extent that their cash flow has turned negative, right? So from that point of view, the deposit base of SVB is going down. But meanwhile, basically, the government bonds that it's sitting on have lost money. Okay. Now, in fact, at the end of 2022, and this is no surprise, everybody knew this, at the end of 2022, basically, SVB was sitting on unrealized losses about $15 billion from basically just its holdings of US government bonds, whereas its equity capital is only $16 billion. So we knew at the end of 2022 that this was a bank that had basically zero equity capital, okay, in the bank, okay? Now, I would argue, so, that's why I got downgraded and this and that. But what happened last week was just pure stupidity. Actually, the way they went about basically trying to inject capital. And then obviously when 10-year rates went above 4%, investors got worried because, basically they assumed the SVB was going to lose even more money. Okay. And then it became insolvent. Then it became an issue. And of course, they were trying to basically, issue more new equity capital in order to inject capital into the bank in order to essentially keep it afloat. But I just think it was basically a combination of measures that were highly mismanaged, not only by SVB itself, but probably by its advisor, which is Goldman Sachs, okay, that ill-advised them about the timing and so on and so forth. And all of a sudden, everybody wanted to get their money out. And that's it. In a bank, it doesn't really matter how well a bank is run, how poorly it's basically run. Once people decide they've lost confidence in the bank, they want to get their money out, it's over. It didn't matter anymore. In some sense, you could argue SVB's demise is a reflection of its arrogance, perhaps, because it did so well, because nobody's ever gone out of business because they're holdings of the safest assets in the world, U.S. government bonds. And then, therefore, it might have also blindly took advice from its basic advisor, Goldman Sachs. So as a result, all these things, in the end, this bank has not gone out of business. But is that something we should assume reflects the general reality that other banks in the same situation? Because all other banks basically crashed, right? If you look at JP Morgan stock, Bank of America stock, they crashed last week. And yet their situation cannot be any more different. In fact, actually, let me tell you the biggest difference. This is why it's like, there are a lot of idiots on Wall Street and people overreact, okay? Think about this. SVB, most of their basically customers, I'm talking about depositors, are, companies, okay? So they will have to basically pay, basically market level interest rates, okay, to these companies for placing deposits there, right? So if you open a bank account, you just a new startup in town, you open an account with, SVB, and you put in whatever, $10 million. They presumably have to be paying you 4% because that's what you could be getting by just putting your money into U.S. Treasury bills, okay? So that's what you'd be getting, okay? So SVB, from that point of view, as interest rates go up, they did not benefit anyway. Whereas, take a look at, basically bank deposits, okay, at Bank of America, at basically JP Morgan, the big consumer banks. They're paying you still 0 interest rates right now. Because basically, I'm not talking about their corporate deposit base, which is a very small part of their business. I'm talking about the deposits held at these banks by U.S. households. They're currently paying 0. In other words, that basically as interest rates gone up, these banks, which represent the majority of bank assets in the United States, anywhere else in the world, they have become like a money-generating machine for these banks, okay? Because this is why all these banks have seen a massive increase in interest rate margins, because they're still paying 0 on deposits, whereas they can turn around and basically invest these deposits in U.S. government bonds and basically make 4%, 5% in fact, in short-term stuff, okay? So SVB was not in that situation because most of its basic clients are basically companies as opposed to consumers. But whereas for most other U.S. banks, most of their customers are consumers and not basically companies. So from that point of view, there would have been a natural interest rate hedge for all the other banks. They might have also lost money on their holdings of U.S. government bonds, but guess what? Because they were paying now 0 on their deposit when they could be basically earning a lot more. That was basically more than offsetting any losses they might have made from their U.S. government bond holdings. That is the most important thing. So in my view, what's going to happen this weekend is that, personally, I am very envious of goddamn big banks that have the balance sheet right now, because I have no doubt all the big banks from JP Morgan, Bank of America, Morgan Stanley, they're probably all lining outside the FDIC's office, basically with their bid for SVB. Because this will be like the biggest bargain of the century. Because these banks can presumably come in just because my name is JP Morgan. If I take over SCB, guess what? Deposit outflows are going to stop. And meanwhile, I'm going to be able to take over this, crown jewel of basically Silicon Valley that's got all the basically connections into tech, into basically like VCs, into basically new startups. That's amazing. Now, think about that. So given all that, you want to buy? What do you want to sell? I think the explanation should be pretty obvious.
Yeah, it's interesting. So from the US perspective, it's probably not going to be a massive issue for all banks. Is there potentially still going to be risks for the banks that might have more exposure to those business customers rather than the retail customers?
Listen, down the road, I mean, we're talking about right now. If you look at right now, at this moment in time, we look at the delinquency rate on, basically commercial industrial loans, which are the primary, basically business loans. Well, you're looking at delinquency rate on credit card loans, which are the primary loans to consumers. The delinquency rate having gone up over the past 6 months remain basically below their levels before the pandemic, my friend. Okay? Which is to say that the economy is doing well. I mean, which is to say that until now, for one reason or another, that, the economy is still trucking along. I'm not saying that the economy is booming, but it's basically, there are enough people out there that have enough money or making enough money that, even though interest rates haven't gone up, they can still pay. Now, there's a lot of reasons for this. Okay, number one, we're seeing massive reshoring of jobs back to the US from many other countries, especially from China, right? So last year, 350,000 jobs returned to the US from China alone, right? For every manufacturing job, by the way, returning to the US, it creates probably additional 3 to 5 jobs. So that's a lot of jobs. So from that point of view, the US is directly benefiting from the trade war that is declared on China. Okay, and that is continuing as we speak in 2023. Another major, basically, source of support for the US economy, of course, is the fact that we're seeing an explosion of new business formations. It's pretty amazing because immediately after the pandemic started, new business formations took off. But guess what? New business formations remain basically 50% higher than where it was before the pandemic. And what this is telling me is that the pandemic has only accelerated a process that started even before, which is localization. We're moving away from globalization to localization. Like localization, it's not just about, reshoring jobs from China. It's also about the fact that people moving out of big cities into basically suburban areas or even rural areas where, a sense of community is now being promoted. And then people are trying to basically help their local businesses, okay? Whether it's the local farmers, the local basically supermarket, the local whatever, craftsmanship, and so on and so forth. So as a result, I think that's what's really happening, which is resulting from the basically a huge movement of people, over the last 3 years. What you're seeing right now is small businesses, probably more service-oriented businesses, doing well. And I think that is very important, okay? I think on top of that, I think the fact is that we've seen over the last 6 months, the stock market's gone up, rates have gone down, credit spreads have come in. We've seen basically, a massive loosening of financial conditions. And that probably has also been basically supporting the US economy, let alone the European economy. I mean, because the same thing has been going on in Europe. But that's why coming into 2023, there is a lot of evidence of a synchronized, basically, reacceleration of the global economy from Asia to the US to Europe. So from that point of view, again, this is not to say that the global economy is booming. It's just saying that actually there are green shoots all over, and these green shoots are completely understandable where they're coming from, and that this is the reason why, despite higher interest rates, at least in the US, the economy is still trucking along. And the most important thing your viewers need to understand is that the single most important determinant of delinquency rate, of course, is employment. As long as you have a job, there is a very good chance you're going to be able to continue to make good on your loans. Okay? So from that point of view, with unemployment rate at 3.6% at all-time low, guess what? This is not a problem. Okay. Meanwhile, many millennials like yourself, at least in the US, they think that, all the student debt that they've been carrying for years has now been forgiven because that has been, essentially decreed by the US government. It's now being contested by the Supreme Court. But a lot of people are behaving as though, but right now, actually, there is actually a freeze of even interest payment until that thing is sorted out, which means that, young people can go out and take on more debt because they've just, a very big part of their debt, in fact, the biggest part of their debt has just been basically taken off. And then on top of that, 66 million Americans just seen a basically 8% increase in their Social Security check at the start of this year as a result of the cost of living adjustment, which means more spending power. So what I'm telling you is this, is life is not so simplistic. People say, oh, wow, interest rates gone up, SVB just gone down. Look at half of Wall Street banks must be in the same situation. Sell, 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 sell. That's what happened in the last 40 hours. And I think that is a kind of, total mischaracterization of the situation, reflects how little people actually understand what's really going on. Tells me there's a lot of emotional trading going on, and people shoot from the hip, and this actually creates great opportunity. In fact, I would say that next week, on Monday morning, you should be looking to basically buy some bank stocks. I'm not saying you basically buy these bank stocks and hold it for the next 10 years. What I'm saying is I think there's a 10% upside after what just happened last week.
Yeah, it's really interesting to think, as you said, there's really this big divide between the economics and what people are thinking at the moment. So if we look at this issue, and you mentioned at the start, it was really a duration issue. This SVB, obviously they had deposits from Silicon Valley, which had an impact, but they also had these safe assets that were long duration that they thought they could probably sell for a similar price, but because interest rates continue to go up with the Fed continuing to increase interest rates, they just devalued to the point where they couldn't get the amount of money that they needed to keep the bank going. Is there a risk that maybe some other institutions, it might not be banks, it might be shadow banks, it might be maybe international Eurodollar banks, have a similar issue where they have this sort of loss on their balance sheet that they haven't realized yet? But if this run on a bank occurs again, they might have to, and it could have a similar impact?
I think at this particular moment in time, I'm doubtful, because again, it's not like we didn't know the SVB, had an issue with its holdings of U.S. government bonds. By the way, even though these bonds were held in a long-term investing account, in other words, they were not required to be marked to market, okay, everybody knew about them. I mean, just think about this. This is a traded bank, and then they were regulated. It's got credit rating agencies, so everybody knew. So it is just, maybe some people didn't know, and then perhaps apparently a lot of people didn't know, and then they were surprised to discover this was a situation. But that information was out there. So from that point of view, again, if there was a similar situation going on, lots of different banks, you think there was any way the market was stupid enough to have ignored that? I mean, that's what Wall Street does for a living. You've got hundreds of bank analysts, people who just specialize in investing banks. I mean, I have no doubt they're probably thinking like me, like what happened last week. It was more stupidity than anything else, okay, on the part of management. The timing, maybe the whole Silvergate thing in Goldman Sachs, who knows? A lot of people are going to say, oh, Goldman, who knows? Like, these guys probably would love to be able to take this opportunity to make a bid for Silicon Valley Bank. So they might have had an incentive to screw them over. I don't know. I doubt it. But what I'm saying is that the point here is that it didn't have to happen that way. And then certainly, I mean, sure, at any given point in time, they're going to be skeletons in the closet and so on and so forth. And sure, I mean, if interest rates continue to go up, there will come a day of reckoning, But the question is it today? Is it next week? Again, anybody who wants to invest long-term have been absolutely eaten alive by the market over the past year. I mean, don't talk to me about long-term investing, because actually, I think long-term investing has become a code word for, I don't know. Because I have no idea. I can afford to be a long-term investor. What does that mean anyway? Long-term, we're all going to be dead, right? Long-term, everybody's going to be right at a certain point, right? I mean, if you be a long-term investor in stocks, whatever that done last 20 years, you've done very well. Bond investors as well. But I think to the extent we're at a turning point now, you got to basically talking about long-term is almost completely meaningless. And this is what your friends and your listeners who are young people, I imagine, then you need to understand this. Because long-term, at this point, anybody we start talking about long-term investing, you should just tell them what does that mean? Like, what's your horizon? Anybody who's talking about making a prediction about market that does not have a time horizon, okay, basically specifically that person could be held accountable to, is basically, in my view, a charlatan.
Yeah, it's a good way to it's sort of what the banks did. They had these losses in the balance sheet. They're just saying, oh, we don't have to realize them, but there comes the point where you might have to. But if we go back to, you've mentioned that they had some poor advice from Goldman Sachs. I don't think we've specified what that was. They tried to actually sell stock to raise capital to keep the bank alive, basically, and that the market reacted very poorly to that. So I guess in future, we're definitely, if there are any issues in banks, we're definitely not going to see that play happen again.
Listen, I've been predicting 4% treasury yields since basically, I think the February 1st. You can actually look at my channel, that kind of stuff. Like, I've been saying this. The writing was on the wall. Like, you know what? So from that point of view, if you are dumb enough, to have not recognized that there's such a thing called interest rate risk. By the way, most banks, like, you know what? Most banks, guess what? They're probably the highest paid people there are basically the rates traders, because banks are sitting on huge, basically, holdings of government bonds. And most of these bonds are sitting in long-term investing accounts, by the way. That's the nature of it. It's not like banks don't realize the P&L mark-to-market, basically, because they don't want to. That actually, this is a regulatory thing, because U.S. government, just think about your regulator, does not want the volatility of U.S. government bonds to be the single biggest driver of whether the U.S. banking system is solvent or not. Right? Because that's not how you basically run an economy. That's why these banks are allowed to basically have these non-mark-to-market basically account. Okay. But my point here is that nevertheless, banks spend a lot of money and time trying to hedge against basically, massive interest rate basically increase, like we saw basically last week. Right. So basically, from that point of view, it was clear. It was so clear that U.S. interest rates were heading higher at the start of the year. It was not even funny. So from that point of view, all I can say is that I don't know who the advisors are. Perhaps, if you're a Silicon Valley bank, you think that the only thing that matters in life, in the world, is basically tech stocks and then technology. You don't really care about such a mundane thing like interest rate volatility and so on and so forth, that you did not think through about the risk, because these guys normally, they don't sit on naked risk. They might decide to reduce duration. They could have done a lot of different things to basically hedge against the possibility of being basically hit. For example, if they had a massive, think about this. We know from their own reporting at the end of last year, they were sitting on $15 billion of unrealized losses on U.S. Treasury holdings. And then we had a mother of all rally in U.S. Treasuries at the start of this year. You don't think that when 10-year Treasury got down to whatever, 3.2%, they should have basically come in and hedged some of that? I mean, it is crazy. So if they didn't, that tells me they're no better than hedge funds. Again, what I'm saying is that, I cannot imagine. Again, I've worked with some of the biggest Wall Street banks, okay? And I know how interest rate hedging works, and then how, ego-focused they all are when it comes to interest rate basically risk, because it's the single biggest risk that they basically face. If you're not doing that and your advisor doesn't tell you should be basically thinking about that, you know what? Maybe they should be out of business.
Yeah, I agree. And I heard someone talking about how it's the Fed's fault that they increase interest rates too high. And I just had that exact same thought that you were saying, like, hang on, they were told this is going to happen. They should have hedged for this scenario, but they obviously didn't. And this is the issue with that. And we've seen this happen before. This might be a bit reaching in other industries. So like energy industry in the UK, companies went under because they didn't hedge their energy risk. So it's a real issue. These things are volatile. They're not always going to go down like we've seen in the past 40 years. They have to have proper risk management.
Yeah.
Yeah, definitely. So if we look at the aftermath of it, you said these banks are going to be, some of the big banks are going to be lipping their lips. They're going to be lips. They're going to be looking at it. They're going to be wanting to buy some of it. But then from what I've seen, there are going to be some depositors who might not be able to get all the capital. Most retail investors are going to be fine. Potentially some of those big companies that have more than 100,000, they may be at risk of potentially getting 87% of the capital they had in there. What are your thoughts on that and the aftermath that we're going to see specifically for SVB?
Listen, just think about this. This bank, 10-year Treasury is now back down to whatever, 3.8%, which means this bank is actually solvent today. Okay, well, yesterday at the market's close. Okay, now, I don't know what is the franchise value of this bank. I'm going to assume, they had an equity capital of $16 billion. This bank's probably worth $20 billion, whatever, maybe even more. they're basically, their whole gap right now is zero, probably like they probably positive right now. For any of these banks, any bank that comes in and take over this bank, the next day, everybody will be able to take their money out if they still wanted to. So it's going to have zero knock-on effect on anybody, depositors or anybody else for the matter. I'm not worried about that. Okay.
Okay, that makes sense. So if we look at sort of, I guess, the economy in general, you've mentioned how at the start you think the economy is going really well. There's sort of this trade war that's benefiting the US with manufacturing jobs coming back to the US. Are there any other sectors that you're really looking at and you think over the next coming years are going to benefit from some of the macro tailwinds that we've been seeing over the past year or so?
Sure. I mean, I think there are a lot of basically things I like. I like basically, as I say, I like the reshoring story, which will benefit primarily AI and robotics. I like the friendshoring story because reshoring is only going to be one part of the trade war. The other part is friendshoring. And, I just I'll be putting out a video later on today that basically makes the case that India is actually probably going to be the biggest winner in the friendshoring basically space. I also like defense because I think US and China, the way the US is going about business, there's no doubt. The risk of a direct confrontation has gone up dramatically. I think from that point of view, there's no doubt in my mind that, World War III risk is probably much higher than what's priced in. And if you don't want to basically sell everything you've got and buy a farmland, farm in New Zealand and just basically and start building a nuclear basement there, the best thing to do is basically buy defense stocks. I think, Lockheed Martin looks like an attractive basically buy. I also think that obviously long term, I think there's no doubt that the whole the geopolitical confrontation is going to lead to acceleration of diversification of the U.S. dollar. There's no doubt gold is probably going to be the biggest beneficiary of that. So I think there's a whole investment thesis out there that I think that really gets to the heart of the kind of broader, the longer term environment that we're in, because we are probably basically literally at the start of at least a 10-year cycle where things are going to get really, really, really bad geopolitically speaking, but there will be some winners. And you just have to basically park your money in the right places to make sure you don't get screwed completely.
Yeah, and it would be more volatility due to this risk, which is hopefully going to benefit the people who choose right.
Whatever. I think the point here is that we have never seen a situation like this because reshoring and friendshoring and trade war, all this basically means is that we're going to be talking about higher inflation and higher interest rates going forward. Real rates are going to be higher. There's no doubt about that. And there's also no doubt in my mind, we're going to be heading towards stagflation. There's no doubt about that either. And I think from that point of view, this is why, I think politics is becoming increasingly important. This is why I thought, for example, someone like Liz Truss was a complete disaster for the UK, okay? Because she was ideological. She was literally eating off the plate given to her, fed her by Washington's neocons. I think I'm very bullish on basically Rishi Sunak, for example. I think Rishi has shown himself to be a pragmatist. So I think this is an environment in which, if you're ideological, you want to invest in countries where politicians are pragmatic. We're not trying to get caught in the crossfire between, basically the unipolar world and the multipolar world. And you want to basically avoid countries that are led by essentially ideologues who don't give a damn about the welfare of their country, who just want to basically get the other side. So I think, from that point of view, this is the kind of thing that I think is another defining characteristic of basically, I think, the, investment environment in the next basically few years, which is that, some countries are going to do better than others. And those countries are going to do better, are going to have leaders who understand that they're not going to be any winners if you start taking sides. Okay. And then the best thing you can do is to basically stay on the sideline and play both sides. And I think the UK, for me, all along, should have been basically playing both sides. And then I think, I think Truss was a disaster. I think basically Wallace is a total disaster. But Rishi Sunak, now having basically scored a major victory with the EU on bringing home the deal for Northern Ireland, which I think is perfectly workable. Again, shows its pragmatism. Now coming back from France with a deal with Macron on immigration, which I think is going to give her another big win in terms of basically the right, conservative right. I think politicians like him, you'll see, are going to be rewarded in terms of the market is going to basically show him a lot of goodwill going forward.
Yeah, definitely. I think that's a great way to put it. And then do you see maybe China? Do you think that would be an investable country, and those countries that sort of maybe go to that direction? Do you think they'll be investable in the future, or should people stay away from them? What's your thoughts on that?
I think China, you want to stay out of it because things are going to get worse. Because what your viewers need to understand is that right now, listen, I mean, it was a great example. I did an interview with BBC last week, and I was talking about basically this latest decision by the Dutch to basically impose additional sanctions on basically the type of lithography machine that they're allowed to basically export to China, okay? Now, what's interesting is this, okay? So this whole entire story, okay, relates to one company, one Dutch company, which is the crown jewel of the Dutch economy called ASML, okay? Holland is great for making great cheeses and that kind of thing. They're a major agricultural exporter and so on and so forth. But when it comes to basically like tech, they got one company, but this is a world-class company, ASML. They make lithography machines that are integral, basically, piece of equipment for manufacturing semiconductors. Now, already in 2019, okay, under pressure from the US, ASML basically put in a ban in terms of selling their most sophisticated machines called EEV to the Chinese, because that was at a time that the Americans decided they didn't want the Chinese to be manufacturing high-end, advanced, semiconductor, basically. So that's fine, okay? What they just announced last week is that, again, coming under pressure from the US, they've decided to stop selling their low-end machines to Chinese as well, called DUV. These low-end machines have been sold to Chinese, like literally like middle-of-the-road, low-end semiconductor manufacturers, okay? So clearly the US is not just trying to kill China's ability to produce high-end chips. They're trying to destroy the entire Chinese semiconductor industry from top all the way to the bottom. Now you tell me if China is an investable country, because the US has decided to basically take out China before China becomes even stronger. I think that is the only, it's not about China, it's not a democracy, whatever. It comes down to the fact the US is waking up to the realization that China, you know what, there was just basically a report that came out this week. I don't know if you saw. It's an Australian think tank funded by the Australian government, spent the past year going through 2 million basically science journal articles and trying to compile a ranking of which countries are leading in which technology area. And what they came up with was that China is actually leading the US in most of the most important technology. Wow. It's interesting because, this itself is interesting because you know what? You see yourself, like people say, oh, wow, China's been engaging in intellectual property theft. I don't know. It's like, you know what? I can understand. I'm not saying it doesn't happen. I'm sure it happens. The US became very good in technology in the 19th century from stealing from British technology. I will tell you, this is why 19th century, like Britain, literally, like if you were trying to get your own, the British basically machines for basically making wool, weaving machine to the US, you could have been basically put in jail. You could have been hugged, by the way, because UK actually also, Britain then basically had a protectionist policy vis-a-vis its technology. But the Americans, actually, was the presidential order. They had like spies in Britain stealing technology. And but nevertheless, it took the US 100 years to become number one, to basically surpass the UK to become number one technology. Now you're telling me that somehow the Chinese were stealing from the US for the last 10 years and now become number one already? I mean, you cannot steal from number two to become number one, as far as I'm concerned, in such a short space of time. And I think that is the reality. The reality is that Americans are waking up to the realization that the Chinese are very good at what they're trying to achieve. And they're going to be difficult to beat. So the Americans decided, let's take them out before they get any stronger. And that's what this is about. Now, so once you've decided this is what you're going to do, you're going to go all the way. This is why I have no doubt the US is now going to go like all the way to destroy the Chinese economy. Now, so, and I have no doubt in the short term, because America, we still live in a unipolar world, China will fight back, Russia will fight back, and so on and so forth. But in the end, it's going to be lose-lose for everybody. But there is no doubt that, at this point, it basically turns China into an uninvestable country, in my opinion, for obvious reasons, because the US wants to kill China altogether in order to basically make sure China does not undermine, or challenge its hegemony. And what we've learned over the past year is the US is willing to go to great distance to accomplish that goal. For that reason, you want to stay away from China as much as you can.
Yeah, great.
But this also means ultimately China and Russia are going to get into bed together, and China and Russia together with the synergy between the two, and then working together, long term. Again, I don't like talking about long term, but long term, there is no doubt in my mind, who's got basically the upper hand in this. But be that as it may, but the world economy is going to suffer, the market is going to suffer as a result. Of that much, I have absolutely no doubt.
Makes sense. So David, thanks so much for your time today. I really appreciate it. So my last question is, what is one message you'd like people to take away from our conversation?
I think the main thing is to realize there are things that are real and there are things that are not real in terms of an investment themes. And I think there's a lot of propaganda out there. There's no question, which basically makes it difficult to see, basically the truth from the lies. But I think, and by the way, this is even more so on YouTube than anywhere else, because people are just trying to basically get, you know how it is. People are trying to basically sell a sensational thing to basically get YouTube subscriptions so that they can get themselves paid. But the point here is that, at this point, you really have to know what is real and what is not real. And when markets are driven by things that are not real, you want to take the other side. And that's it. In my view, in that sense, volatility ought to be your best friend, because volatility, especially when it's driven by perception of what's real and not real, guess what? That's where there's a huge opportunity for people who are able to see through the noise and get to the core. And that person is going to make a lot of money, as opposed to the long buy to hold long-term investors.
Yeah, I agree, and that's a great message. So, David, thanks again. We've mentioned your great YouTube channel and your sort of Unbound as well. Is there anywhere else that people can find the work that you do?
No, that's, check out my YouTube channel. If you want to learn more about my investment strategy, you can check out my blog, davidwonbound.com.
Perfect. I'll put that in the description below. So thanks again for your time.
Okay, thank you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.